In this week's video, we'll cover numerous stock market signals, including one that's only been flashed 4 times in the last 90 years. We'll be moving quickly, so feel free to use the pause button on your video player. Clients and regular viewers are well aware of the concepts on the screen. If you're new to these videos, I suggest you review them. Stock market signals, historical studies, they're reference points. They give us something to manage against. We always have a base case, and then every week we'll ask, do the charts and data in front of us align with or contradict the base case? Thus, the material that follows can help us under bullish conditions walking forward, can also help us better understand bearish conditions walking forward. From a Seeking Alpha article dated July 12th. In a criminal case, jurors want to see the weight of the evidence evolve over the course of the trial. Our approach to the markets works in a similar manner, so let's go back to mid-May, Seeking Alpha articles dated May 18th and May 22nd. If you read them, they basically say things are not nearly as bad as most believe. It's July now, so it's easy to forget that on May 26th, the market was dealing with the possibility of a, quote, catastrophic, unquote, default. CNN article dated May 24th. Article down here from the Hill dated May 16th. And in the Friday, May 26th video, you may remember we covered this chart dated May 25th, XLK, the tech sector ETF relative to IEF 7 to 10 year treasuries. And we said this was a very constructive setup over here on May 25th, even better than this constructive setup here in Q1. We also said this look from a common sense perspective didn't really align with the word catastrophic. At the time, simply telling us to keep an open mind about better than expected outcomes. Similar situation here. All these charts covered on May 26th. Debt ceiling still in the picture. Very constructive setup. Another constructive setup, May 25th. S&P 1500 relative to SHY 1 to 3 year treasuries. This looks significantly better from a probability perspective relative to this, and this is even constructive here in January, but this looks even better over here. Same can be said for this chart, S&P 500 relative to 1 to 3 year treasuries. It's that tight convergence of trends look. Trends on multiple time frames spanning from the 20-day moving average, in this case out to the 250-day moving average in black. In that same May 26th video, we covered this chart dated May 26th and said the fact that we were holding over here in an area that had acted as resistance in 2021 and resistance in 2020, part of the weight of the evidence telling us to keep an open mind about better than expected outcomes. Large chart dated May 26th, very similar situation. If we zoomed in on May 26th, we said this look here, BIL divided by XLK, looked a lot like 2009 here after the major low in the S&P 500 index. A lot to be concerned about on May 26th. Robotics and AI ETF BOTZ is the ticker symbol, May 26th. We also had a lot of evidence in hand, observable evidence, telling us to try to be patient in the context of markets that had been basing and trying to break out in a bullish manner. You may remember we said this was a favorable setup here, but on a relative basis, BOTZ had been underperforming XLK. Another chart covered in the May 26th video, DeMark chart dated May 23rd. These are wave counts here, and we noted that SMH, the semiconductor ETF weekly, was being labeled as a wave 3 up. It's very constructive. So as we're seeing the weight of the evidence evolve covered in these articles dated between May 18th and June 7th, we see something like this, and this, it was reasonable on June 16th to revisit the secular trend thesis in detail. You can find it by Googling the title on your screen. And on June 23rd, we noted it was important for us to understand that we're operating in a different environment. But given interest rates were rising between 1950 here into the late 1970s, early 80s here, this isn't necessarily a showstopper for this. Secular trend here begins in 1950. Interest rates start to rise in the 1950s. And yet, really good things happened in the S&P 500 for a long period of time. We noted the present-day situation is being driven by demographics related to the millennials and an interesting twist, a factual twist, on the baby boomers. And the concept of the evidence building in a constructive manner over time is important because from a psychological perspective, it's very, very difficult. No matter what point in time you're presented with a number like this, potential gain 142% from where we are roughly in the present day to the peak of this secular trend in the 1970s, and very, very difficult to conceptually wrap our heads around an additional gain potentially in a secular trend of 444%. So ultimately, we're trying to understand, does the weight of the evidence in the present day align with something like this or something like this? And more importantly, the fact that stocks could go up at this point for another 1 to 3 years. You can find a lot of links and information in this post here on our blog Short Takes. You can find it by Googling the title on your screen and our last name, Ciovacco. Also noteworthy, in this June 1st post here, title of it, if this ratio flips, it may be time to sell stocks and buy bonds. This is the kind of flip that we're talking about, year 2000, final leg down in the bear market here, S&P 500 relative to the price of a 10-year treasury note, so stocks versus bonds. Full bore bearish. You can find the details in this post dated June 1st. So how does this exact same chart look today? Is it concerning like this? Is it screaming imminent recession like this? The answer is no, as we've covered previously. This is a bullish breakout for risk on S&P 500 relative to the price of a 10-year treasury note. This chart here, basically the same ratio here, and the same ratio covered here. Not screaming imminent recession, not screaming major hit to earnings coming, not screaming the Fed is about to cut interest rates. Thus, it's logical, given all this and all of the information covered in this video, we said back on June 23rd that we could sum up the rationale behind taking on new clients for a limited time with one word: opportunity. So let's keep this date in mind, June 23rd, and the term opportunity. We also noted in late May, headline A, headline B really didn't align with the most important data sets relative to the probability of a recession on May 26th. And then on June 30th, respecting that it's easy to shrug off something like this or this, we asked and answered, does the weight of the evidence support the resumption of the secular trend in stocks? And if you watched that video, at that time, the answer was yes. And we did so using multiple data sets, multiple markets, and multiple time frames. We noted that the look of this chart, dated June 28th, covered on the 30th, and the look of this chart told us to keep an open mind about inflation possibly cooling down a bit relative to subsequent reports. And this chart, dated June 30th, covered on June 30th, looked like the resumption of the leadership trend in XLK relative to the S&P 500, making a stand at an upward sloping 200-week moving average. So back on June 23rd, we talked about opportunity. Thus, it's logical to think if we've been talking about opportunity, and we've been talking about constructive setups, and we've been talking about improving risk-reward profiles, we would hope that the S&P level on June 23rd of 4350 would look a little bit better several weeks later on July 13th. This segment of the video is being recorded on Thursday evening, July 13th, and the market has continued to respond to the positive setups. We moved from 4350 to 4510, aligning with rather than contradicting the concept of opportunity. And since we've been referencing improving odds relative to longer-term opportunities, and since we'll be covering recent signals in this week's video, it's reasonable to ask the following questions. What does long-term opportunity mean? Historically, how much upside could be left in stocks? And do the signals that we're about to cover align with or contradict the secular trend thesis? Do they align with or contradict a very difficult to wrap your head around number like this or a number like this? And at the end of the video, we'll talk more about this topic. Since some of the studies we'll be covering are based on Ichimoku clouds, it might be helpful to revisit some slides that we covered in 2022 on that subject. These are weekly clouds, dot-com bust bear market, financial crisis bear market. From a trend perspective, it's helpful to understand what does it look like when we flip from a bullish trend to a bearish trend and then back. You can pause your video player if you want to look at these slides in more detail. From a bearish perspective, green below price, green below price, price below the cloud shifts from green to red, price below the red span, below red here, all observable, and blue drops below red here, and it drops below red here. After that, a lot of bad things still to come. Conversely, when the bear market's over and the major low is in place, we can check these boxes over here. Observable and measurable, observable and measurable. Objective rather than subjective. Very similar situation in dot-com bust bear market. Discernible and negative, discernible and incremental improvement over time after the low. Odds much better here relative to here. And again, all of this covered in 2022. Financial crisis, transition from bull to bear, these things happen. Transition back from bear to bull, these things happen incrementally over time. Part of the weight of the evidence improving over time. So with those cloud concepts in mind, let's revisit our 3 questions. And let's look at the signals that recently occurred in 2023 to try to understand how they can help us. We already noted at the end of May, the major recession-related data sets looked good. Same thing can be said on July 13th. These are small charts, but it's pretty easy to spot some of the deterioration in the data near recessions. It's not really what we have on the right side of these charts. Access them from Fred on July 13th. Is it possible all of this changes very, very soon? Of course it's possible, but it hasn't changed yet. Observable and measurable evidence, objective evidence. This is what a bear market looks like here in the NYSE. Now checking all of the bullish boxes. So we wanted to know, when the NYSE composite, when price, weekly price, drops below the cloud for 6 consecutive months, and then recaptures the cloud along with the green span, blue, and red for the first time on a weekly closing basis, how did the market perform walking forward? So approximately 6 months below, and then we want to be able to check this, and this relative to the cloud as we can in July of 2023. So we looked at data going back 50 years, and as you might imagine, there were only a handful of cases. So these dates here, similar to July of 2023. And in the historical cases, what happened walking forward? In this case, we're looking at S&P 500 performance. 1 year later, every single case the market was higher. 3 years later, higher. 5 years later, 88% of the cases higher. 7 years and 10 years, 100% of the cases higher. 7 years later, a very nice median return. 1 year out from the date of the signal, so that's additional gains. That's not from the low. That's from this point here. Historically, median gain, roughly 12%. 3 years out, 28%. 5 years out, 68%. A lot of green in the table, which seems to align with rather than contradict the secular trend thesis. The NASDAQ weekly cloud chart on your screen is dated June 15th. You can see it's improved considerably relative to the look back here in 2022. And all of the hard data and all of the charts speaks to all of this and all of this. So like the NYSE composite, the NASDAQ was checking all of the bearish boxes back here in 2022, and now it can check all of the bullish boxes. So we wanted to know, when the NASDAQ weekly stayed below the cloud for 6 consecutive months or more, and then had 3 consecutive weekly closes above the cloud, similar to what we've recently experienced in 2023, how many times did that happen, and what happened next? In the history of the NASDAQ, only happened 5 previous times in 1985, 1988, 1991, 2003, and 2009. And if you know your market history, it's not surprising that the market was higher in every single case 1 year later, 3 years later, 5 years later, 7 years later, and 10 years later. The additional gains, not from the low, the additional gains after the signal, average gain in the NASDAQ composite roughly 19%, 3 years out 28%, 5 years out roughly 80%, 7 years out, 10 years out, very, very satisfying numbers. This is basically saying we were in a downtrend and now it looks like we've flipped to an uptrend. Doesn't predict anything, it speaks to probabilities. Drawdowns relatively muted, but we have to have realistic expectations about how markets operate in the real world, especially in the context of rising interest rates and higher inflation. Our goal is to navigate between a point A and a point B that could be several years down the road. Our goal is to navigate hypothetically between a point A and a point B that could be several years down the road. To capture this, or to capture a large portion of a number like this, or a number like this, we have to remember there's no free lunch in the markets. To get to the right side of the table, we have to be willing to withstand 100% normal and to be expected volatility that occurs within the context of all trends. Even the strongest uptrends have significant counter trend moves and significant drawdowns. And given this, most likely volatility in the future will continue to be high even in the context of a secular trend. Looking at a chart of the Dow Jones Industrial Average going back to 1980, chart spans 44 years. We're looking at the monthly Kopic curve down here. We wanted to know when the Kopic curve drops below zero, as it did in 2022, and then recaptures the zero line, which it's attempting to do in the month of July. It's currently above the zero line at 1.69, chart dated July 13th. So when we see a move like this, followed by a move like this, it's helpful to know how many times has it happened and what happened walking forward. If this is the 1 year maximum drawdown, the average and the median, you can probably surmise that this table is going to be relatively attractive. When similar things happened in the past, in the Dow Jones Industrial Average, what happened in the S&P 500? 1 year later, 100% of the cases higher. 2 years later, higher. 3 years later, 83% of the cases higher. 7 and 10 years later, every single case higher. But maybe more importantly for us, median gain after the date of the signal. The additional gain, because when your Kopic curve goes from negative territory to positive territory, then you've already moved a considerable way. The additional gain, median gain, 18% 1 year out, 3 years out, 41%, 5 years out, just a hair over 79%. Again, that's S&P 500 performance. Very, very similar concepts, but we're looking at a monthly chart of the NASDAQ 100. Kopic curve goes back to 1987. We're looking at all of the data that we have. Chart on your screens dated June 30th. By mid-July, Kopic curve has a chance to close above the zero line, currently above the zero line in mid-July. Doesn't happen very often. Here are similar dates in history. And once again, after similar signals relative to what we have halfway through July, 100% of the cases higher 1 year later, 3 years later, 5 years later, 7 years later, and 10 years later. Median gain 1 year from the date of the signal in the NASDAQ 100, just a hair over 20%, and that is an additional gain after the date of the signal. Data set, NASDAQ 100 stocks greater than their 200-day simple moving average. We're looking at all the data. It only goes back to 2002. What just happened in 2022 is we hit a rare oversold level twice. Only time we've done anything remotely similar, 2008. And in 2008, we got back to the upper blue line, which is very, very similar to what just happened on July 13th of 2023. So we've moved from point A down here to point B up here. Only happened a handful of times, 4 times. After the low in 2002, after the low in 2008, 2009, after the low in 2011, after the low in 2018, and after the low in 2022. And if we slide it, even though in the historical cases the NASDAQ's already moved a good way, the additional gain satisfying 6 months out, 1 year out, 2 years out, 3 years out, 4 years out, and 5 years out from a historical perspective. Simply telling us to keep an open mind about better than expected outcomes, because all of this is based on something that just happened in 2023, and this is based on daily data. It has been nailed down. It's a monthly chart of the S&P 500. It's dated July 13th, and it goes back to 1973 all the way to the present day on the right side of the screen. The indicator on the bottom of the screen, price percentage oscillator, affectionately known as PPO. It is a lot like MACD, but it has some significant and helpful differences when we're looking at data over a very long period of time. So we wanted to know, when momentum sees a bearish cross, the bearish cross stays in place for a long period of time, and then we see a bullish cross, how many times has something similar happened? And we're only looking at cases where the bearish cross was in place for at least 150 calendar days, because those are the cases that are most similar to what we just experienced in the rearview mirror. This is quite a bit greater than 150 calendar days. And subsequent performance, a little bit more mixed, but still very satisfying. 1 year later, median return roughly 15%. 3 years later, 39%. 5 years later, 73%. 7 years later, over 100%. And 10 years later, as you might imagine, very satisfying. And these are the numbers here that are more relevant to us in the present day. The broad S&P 1500, we're looking at a weekly chart with the 30, 40, and 50-week simple moving averages on the chart. Clients and longtime viewers know that this is a full-bore bearish look here, with blue, fastest moving average on the bottom, green, slowest moving average on the top. The slopes of all of the moving averages are down and prices below the moving averages. Conversely, this is a full-bore bullish look, with blue, the fastest moving average on top, green, the slowest moving average on the bottom, price above all of the moving averages, and the slopes are all up. So we wanted to know, after the market has flashed a full-bore bearish look, as it did here in 2007, and then flips back to a full-bore bullish look, as it did in 2009, how did the market perform? Answers on your screen, and quite well. Additional gain, S&P 500 index, 1 year out, roughly 12% is the median outcome. 2 years out, 26%. 3 years out, somewhere in the neighborhood of 35%. How about if we look at the same signal dates and we look at XLK, the technology sector ETF? 1 year later, about 14%. 2 years later, roughly 30%. 3 years later, about 58%. And while some of these numbers look similar, if we compare and contrast this number with this number, this number with this number, and this number with this number, we can see XLK in this case did quite a bit better. It's also noteworthy that XLK has a secular bullish trend look in this window here. Doesn't predict anything. It just tells us to keep an open mind about better than expected outcomes. And if you're a client, you might have logically thought, Chris, you've shown charts in the past of XLY having excellent setups. Been talking about XLK for some time. looking more and more like it's reestablishing a bullish trend. And you've shown constructive setups for XLC communication services. So think tech. So why don't we own more of these ETFs? Well, that's a fair question, one that we ask ourselves. And if you're a client, you know we have some significant exposure to the tech sector. But you should keep in mind, we also have significant exposure to SPY, VOO, etc. Left side of the screen here from Y charts. Sector allocation for SPY. Consumer cyclical, 10.91%. That's XLY. XLY is the S&P 500 Consumer Cyclical ETF. Communication services, 8.4%. That's XLC. And 28.84% of SPY is allocated to XLK. Thus, every dollar that we have in SPY or VOO or a similar S&P 500 ETF, roughly 50 cents on the dollar is already allocated to these sectors. Something that we've known in recent weeks, and it's built into our shorter-term game plan, our intermediate-term game plan, and maybe more importantly, our longer-term game plan. Because if we're in a secular trend, trying to build an allocation that gives us a higher probability of navigating between a point A and a point B that could be several years down the road. So we're thinking a lot longer term than the next 3 weeks, 3 months, or even between now and year end, trying to set ourselves up to be successful for a move like this, from a low to an intermediate term peak, from a low to an intermediate term peak. And typically, that's much longer than 3 weeks, 3 months, or 6 months. Let's move on to the next study. Percentage of NASDAQ 100 stocks, think QQQ, greater than their 150-day simple moving average. And as we walk through this, probably hearing a lot, the market is overbought. And that's accurate. This will provide some context. Right side of the screen. This is what happened last year in 2022. The market was rarely oversold. So rare that if we look at all the data, and the data goes back to 2002 over here on the left side of your screen, if we look at all that data, that type of oversold reading only occurred 1, 2, 3, 4, 5 times. It's extremely rare. And the signal is we've moved from rare oversold territory to admittedly rare overbought territory. But we have to think of it in this context. This is the first move after being extremely oversold. And similar moves have occurred by hitting the same level that we just reached this week. So the signal is based on something that just happened, observable evidence. This move from A to B is similar to this move from A to B, this move from A to B, this move down here to B here, A here, B here, A to B, A to B. So does a move like this align with or contradict the secular trend thesis? And in terms of the market being overbought, because it is overbought, was that necessarily a showstopper? So what happened walking forward from similar overbought levels after being rarely oversold? Answer: median gain, NASDAQ 100, 1 year out. This is the additional gain, 23%. The additional gain looking out 3 years, 65% median outcome. 5 years, a double. As always, it doesn't predict anything, it speaks to probabilities. And we have to think of it in this context. Again, technical analysis tracks the past. It does not predict the future. You have to use your own intelligence to draw conclusions about what the past activity of some traders may say about the future activity of other traders. The past actions of some traders, what might that say about the future actions of other traders? This just happened. Think of these numbers here, here, and here, and then think of these questions here. And then something like this or something like this doesn't seem so crazy anymore. Now it has some context. This move from here to here is a lot longer than 5 years. This move from here to here is a lot longer than 5 years. This number here puts this number and this number in some context. The point of the exercise here is not the magnitude of the gains going forward. That's highly variable. But it's the probability that the market will be higher in 1 year, 3 years, and 5 years. And you may be watching and say, the market's always higher 5 years later. Absolutely not true. The market went absolutely positively nowhere from the peak right here in the year 2000 until breaking out into the secular trend 13 years later. Here, secular trend starts to stall in 1968 to the 1973 window in here. Market goes absolutely, positively nowhere until the low in 1982. So to look at a table like this and just assume that the market's always higher in a year, 3 years, or 5 years, it's just not accurate. Context matters. Context matters. This is the Chande trend meter that we covered in detail a month ago when we talked about the secular bullish trend. You can find a significant amount of detail in this video. So the chart here was one that we used about a month ago. It was dated June 14th, comes straight from that video. The trend meter was down here. Didn't hit this darker green band yet. So let's fast forward. And if the analysis from a month ago was sound, we would expect the trend to be even stronger 4 weeks later. And that's what we have. We were down here about 4 weeks ago. Now we're up here. So we wanted to know, it's rare to have a trend this strong up here. You can see before the bear market started, the trend was extremely strong up in this area here. We wanted to know, how often does a trend this strong drop down to this level here, this basic band here, and hold, and then rally back to where we are in mid-July? And we're looking at all the data. You can see the trend meter starts here in 1933. So if we go back to the right side of the screen, the study's looking at 3 moves. 1, 2, with the third being this level here. How many times has it happened? Going back to 1933? Not many. 1958, 1963, 1991. And after a similar 1, 2, 3 move in the same trend meter, how did the stock market perform? S&P 500 performance 1 year later, the additional gain, 13.5%. 3 years later, average gain 25%. 5 years later, back to the median at 44. 6 years later, median 68. 7 years later, 80%. 9 years later, 93%. And once again, you can't assume that the stock market is always significantly higher 9 or 10 years later. It's just not true. A lot of sideways movement here. 1937, we go absolutely positively nowhere to roughly 1950. 1968, we really don't make any progress until we start to move in 1982. And similar situation up here. .com bubble bear market and the financial crisis, the Twin Peaks. So numbers like this are far from meaningless. And here's another thing to consider. There's a lot to worry about in the present day. That's accurate. If you know your market history, based on this signal here, May 2nd, 2003, after a horrible bear market that starts in March of 2000, the S&P loses over 50%. It doesn't bottom until October of 2002. It's long in duration and has an extremely painful magnitude in terms of the drop. Do you think people are confident in May of 2003? Do you think they're skeptical? Do you think they think the market's going to go up 20% in the next year, 50% in the next 3 years, 70% in the next 5 years? I know the answer to that. I lived it. The answer is absolutely positively no. So if we're skeptical in the present day, that's not unusual. Similar situation here. In the present day, we could be thinking there's no way something like this is going to happen. You know how many people were saying there's no way something like that's going to happen on May 1st, 2009, after the S&P 500 peaked? In October of 2007, and didn't bottom until March of 2009. And in between point A and point B, it lost over 50%. So where do you think sentiment is in May of 2009? Is it expecting anything like this? It's not. And I think these numbers here are healthy. That's not a massive gain walking forward. That's not a massive gain walking forward, nor is this. And if you did have to guess, the market's moved a long way already. This seems about right if the signals are accurate. But this isn't what we're concerned about. It's this, and this. Which brings us back to that word uttered weeks ago, opportunity. How about these dates? September 1958, May of 1963, end of March 1991. What can we learn from those dates? Signal number 1, signal number 2, signal number 3. What do they have in common? And these are the only signals going back to 1933. What do they have in common? Maybe it's just a coincidence, but they all occur in the middle of a secular trend. In the middle of a secular trend. A secular trend that still had a long way to run. A secular trend that still had a long way to run. Walking forward from this line to this peak, this line to this peak, and this line right here to this peak. By the way, all three of these lines are based on something that just happened. A move from 1 to 2 to 3. Also noteworthy, if you look at this objectively, the other periods that are very, very close to checking these boxes up here, the parameters for the study, 1953 comes very close. You don't come down to the line, but it's very close. So you hit this line, you come down here, and you get here. You get 2 out of 3, and it's very close to getting 3 out of 3. 1987, exact same thing. The market's very, very strong. It gets weak. It just didn't get as weak as we did over here, and then it bounces back to the same level we are today. This occurs within the context of a secular trend. So does this. So does this. Secular trend in 1987 after the low. Secular trend here in 1991. We also come very close in 2020. We don't check these boxes, but we're very, very close, and every single one of them occurs within the context of a secular trend. And the gains after the similar signals, it's pretty easy to say they align with rather than contradict the secular trend thesis. Bear in mind, this is something that just happened in July of 2023. And it aligns with the concepts that we covered 4 weeks ago. And concepts that we've been covering for several years in terms of the secular trend. So remember earlier in the video, we asked, what does long-term opportunity mean? Historically, how much more upside could be left? And do the signals align with the secular trend thesis? I think the results answer all 3 questions. Nothing subjective here. It's all objective. This is a measurable move from here to here to here. It's a measurable move from the 1950s to here to get back to here. It's a measurable move in the 1960s from here to here and back to this level here. Same thing can be said here. Market is strong in here, comes down to a level very, very similar to what we did in the present day, and eventually makes it back to this line here. In the secular trend windows, and there was still upside left in the market, and that's additional upside after the move off the low, additional upside after the move off the low, and additional upside after the move off the low. I also think it's noteworthy. We covered these charts on June 6th here. We said some of the next moves we wanted to see, global stocks, VT, RSP, equal weight S&P 500. And then we noted on the 12th, they were starting to do, 12th of June, what we wanted them to do. This and this are still checking the bullish boxes. And in fact, one of your laggards in the bear market, XLC Communication Services, is in the process of trying to do something very, very similar. It's above the anchored volume weighted average price line, tied to the high before the bear market started. It's relevant, and that would be relevant for SPY, since one of your laggards is starting to say it's possible my bear market is OVER. If you're interested in possibly taking advantage of the new client window, ton of information in the form of FAQs on our website. Here's the main menu. These are the major topics. One question not covered: can you manage an account with existing positions? The answer is yes. We have a way to handle that. We can provide details via email or via phone. I believe, as we stated a few weeks ago, why would you lower your minimum? Because we'd much rather have new clients come in when we're close to some of these basing formations. It's not right here where all the new accounts come in, and logically that makes sense. People are still scared. They've just went through something painful. Typically, a lot of new accounts come in here, harder to manage. This is a much easier spot to take on new clients, and it's also better for our existing clients if we do so in this window, rather than this window or this window or this window. Another good FAQ. This would be a good logical next step. You can find the email address upper right-hand corner of all the pages on our website as a drop-down menu. Click on Site menu, come down, click on Contact, and you can find the email on the contact page. If you found the information in this week's video useful, we would greatly appreciate it if you could go to our Twitter feed. The tweet for video distribution will be pinned to the top of the feed. It'd be great if you could favorite it and/or retweet it. Similar support on LinkedIn, Facebook, and YouTube, greatly appreciated. Remember, we don't trade historical studies, we trade the charts and data in front of us. Thus, it's extremely important that each week we reassess the charts, reassess the data, and if need be, reassess the probabilities. And we all know the only way that we can do that effectively, so we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Ciovacco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.